Okay, folks, welcome everyone. As usual, the first question is if you can hear me and see my presentation. So if anyone can type on the chat room, if you can hear me and see me, it will be fantastic. Because we're in YouTube, then it's gonna be a little delay. They usually buffer this about 10 to 20 seconds. So please let me know. Okay. Yeah. So I guess I could always change the rate, the latency of the video, but I always forget to do that before I start the live video. So again, welcome everyone. Let's start right away. Okay, so we closed, well, we had an unofficial VRP trade last week, and we hit the jackpot. In fact, we hit the jackpot in the last two. It's always human intervention that affects the system. So for those of you that managed to keep the positions open, it is fantastic. And I had a position there, so it was good for me too. So that was the only position. And since then, for some reason, the Ultra hasn't given us any new signals, which is interesting until today. So let's jump right away to the market regime. The GT level for today is quite high, it's quite elevated, and it's very curious that it's moving up so quickly. The market is still above it, which means that we're in a long gamma regime. And long gamma is always good. As you saw some time ago, at the end of January, we flipped short gamma, and short gamma means lots of volatility, and sure enough, we got tons of volatility when we flipped short gamma. But we're back in long gamma, and long gamma, it means boring. Long gamma means very slow markets, it means very low realized volatility, and it usually means upside drift. And the GT level, for those of you that don't know what the GT level is the gamma threshold level. It's the level where options dealers in the S&P 500 are neutral. Okay, above that level, they have to hedge in long gamma, and below that level, they have to hedge in short gamma. So right now you can see a hedging imbalance. The hedging imbalance is gigantic. It's 24.7 billion to the upside selling and 14.6 billion buying to the downside. What does it mean? I know some of my members are confused about what the imbalance means. The imbalance is just that if the market doesn't move at all, option dealers will not have to do anything. No, they are hedged. No, they are always perfectly hedging risk, and they are happy. But the problem with the options is the moment the market moves, they have to re-hedge again because of the gamma effects. Remember, gamma changes the delta they have to hedge. So because they do that, they need to re-hedge. And what this means is if the market moves up 1%, remember I always use 1% for the S&P 500. If the market moves up 1%, which is around 39 points at these levels, they need to sell, they need to add shorts. They have to add to the shorts they already have. So they need to sell an extra 24.7 billion, which is a gigantic amount of notional selling. And vice versa, if the market moves down 1%, they need to buy, so they need to cover shorts for 14.6 billion. What does it mean? It means that if you notice, dealers right now are opposing the market. If the market goes up, they need to sell, so they will tend to slow down any upside moves. And in the same sense, if the market moves down, they need to buy, and they will tend to slow down downside moves as well. And right now, the amount of buying and selling is meaningful. This is a lot of money. And because for whatever reason, there is very little organic trading, then these imbalances are keeping the market really slow and boring. It's very range bound, volatility is very low, and there is only just a little bit of a drift in the market. So that's the reason why, because we are long gamma and there is heavy long gamma. I mean, there's lots of imbalances, so that keeps the market range bound. And for how long this effect lasts? Well, it could last from any time from one session to 5. And the reason I have really short periods of time for this effect is because the GT level is changing consistently. It changes every time. It changes when the market moves. It changes when options are being bought and sold. So every time that there is a change in open interest, the GT level changes. So if the GT level keeps moving up, it might catch up with the market, and we might flip short gamma, and this thing completely changes. But as long as the imbalances are this big, the market should be really slow. I have a question from Richard. I just heard that if you add the absolute value of I'm down, you have the market move. No, it is 1%. The 1% of 3,912 is around 39 points. That's what I mean about 1%. So this imbalance is if the market moves 1% up or down, which is around 39 points. It has nothing to do with the absolute value of the imbalance. It's just a coincidence that it more or less adds to the same. No, it could be very different. It's just a coincidence that they add up, but it's only 1% moves. It is computed for 1% moves. I could have computed this for any arbitrary move, but 1% is at least in the S&P 500 is a good interval where dealers tend to update the hedges. No? So that's what we have in terms of market regime. In terms of volatility, okay, volatility is finally normalizing. The realized variance in the S&P 500 for the last month went down to 16.84, which is kind of elevated. And the reason is a little elevated is because it includes the craziness that happened at the end of January, beginning of February with the GameStop thing. That really exposed weakness in the market, and that's why it's so high. While the volatility for the last week is on the low side, it's very low at pretty much 11% for the past week, which is kind of like normal. It's still a tad high, but it's normal variance. So clearly we recover from the structural issues we were seeing at the end of January, but really the whole thing, that whole week really exposed fragility in the market structure. I never thought the market could be this fragile, because the trigger for this was so minimal. It is basically one stock, no? That was the trigger for this. And one single stock exposed a lot of fragility in the whole clearing system, in the central clearing system, and it forced all these margin calls for brokers and capital injections and things like that. People have to liquidate portfolios just to cover those margins, and it really exposed liquidity disappeared briefly for a couple of sessions, and we flipped short gamma in a heartbeat, and the market went crazy, and then suddenly the market is back to normal. So there is something that needs to be done. I mean, market structure is very fragile, and I think it's a consequence of all the structural changes that have happened since the 2008 and the disappearance of formal market makers. Now, liquidity is basically provided in a good faith effort. I guess people provide liquidity only when it is not needed. No, there was no liquidity when the market was falling, and that's a tremendous problem. At some point, we will have to readjust how we see the markets and force liquidity providers to provide liquidity even in the way down. Anyway, I'm just digressing. I'll talk about this a little more later. So let's look at the term structure of SPX options. Well, you notice that clearly there is an outlier. That's bad data. It has to be bad data. There is no reason why March 19 is so elevated. So just ignore it for now. The important thing to get from this chart is that the blue line represents VIX values computed right now, and the red line is the same values computed 1 week ago. And you can see that 1 week the market was already recovering from that craziness, but still volatility was very elevated. So volatility in the options, price in the options is coming down nicely. The curve is really nice, barring that bad data point. And I like this in contango. The only thing that I don't like is that implied volatility remains very elevated for some reason. In particular, 50 days out, it is very elevated. It seems that dealers are still pricing a lot of uncertainty. Notice in the near term is below 10. For the first 25 days, notice that the implied volatility for the options goes from like 10 to 20, very, very low, but yet longer term it remains very elevated, and I guess that reflects the uncertainty of the whole thing we are seeing, I guess. I still think that options are tremendously overpriced, in particular options 50 days out. They are tremendously overpriced, but they have remained overpriced for quite some time, for more than a year now, or almost a whole year. And VIX has remained really, really overpriced as well, because really VIX represents 30 days, so it's around 20 now. So the big question is, when will finally VIX break below 20? And the question is important because once it happens, I'm pretty sure that the whole curve will collapse massively. My expectation is that all of those data points that are above 25 will fall towards the 20 or even below. So we'll see. I guess it all depends on what is the progress of this particular pandemic and how the economy reacts for the rest of the year. But right now, option dealers are not seeing anything if I ignore the point for March 19. So if you have any questions about volatility, please try to get in. Remember that there is a delay of around 10 seconds between when you type the questions and I see them. So I will continue, but as soon as I see a question, I will stop and answer it. Realized variance. God, this was a surprise. You can clearly see a tremendous bump. January was kind of normal, and then you can see a bump. Let me see if I can highlight the bump. I don't know how to use the highlight tools from. No, I don't know how to use them. No. So in any case, I don't know if you see my cursor or not, so that's the problem. But you can see that we have a tremendous amount of realized variance recently, like higher than 20%. And it coincides with the peak of VIX as well. VIX is the red line, intraday realized variance is the blue line. And remember, for those of you that are new to this broadcast, remember that realized variance for us is a proxy for liquidity, no? So clearly liquidity disappeared at the end of January, beginning of February, but it completely disappeared. It was basically crash-like levels, basically what we saw in early March of 2020, in late February, early March. Liquidity started to disappear out of the blue for no reason. Well, the reason was people raising cash for margin calls, but that should not induce this kind of liquidity event. There was a tremendous liquidity, and this is how I come back to my point that in modern markets, in markets since 2008 and even more recent since 2015 probably, liquidity is just an illusion. Like we have the illusion of liquidity. For instance, right now, realized variance is nothing. And we think, oh, there is plenty of liquidity, but no, because it disappears in a heartbeat. How good is liquidity if it disappears when we don't need it, when we really need it? I mean, we have lots of liquidity right now, but we don't need liquidity at this point. But we needed liquidity a couple of weeks ago, and it wasn't there. And that's a structural failure of the market, and it's something that we have to prepare for the future, because if it happened in this case for something so simple, imagine what will happen if there is a real event, if there is probably a war or some kind of geopolitical event that really induces panic in people. I don't even want to imagine that. There is no liquidity in the way down, basically like zero. So perhaps that's one reason that options remain so overpriced. That's one reason why VIX remains above 20. I'm just speculating here, in terms of what I mean, right now it looks really good. It looks like liquidity is below 10% for several sessions, including today. So everything looks normal, but I don't trust it. I don't trust this because we cannot use this normality to infer anything going forward, because going forward a few months from now, something happens and liquidity disappears in seconds. It disappears really quickly. I'm moving into ambiguity. So I have received many questions about ambiguity in the gamma optimizer room. Ambiguity is the black line on the chart, and you notice that it did anticipate the mini flash correction that we saw. It peaked above the zero point 0.2 level, which has always been the magical level. And it started falling again, and it's now going up. So this time we are going to pay attention, like lots of attention to this. We are not going to ignore it. At the moment ambiguity crosses 0.2 again, we are going to, I don't know, perhaps do some kind of end of the world type of trades, some kind of lotto size type of trades, preparing for downside or hedging for downside, because it has been very good. I mean, the 0.2 level has contained these moves since the last couple of years. So it is an interesting level to keep an eye. But for now, ambiguity looks normal. I'm going to pause here for a second, just in case there are questions about this. But just to, where questions are being typed, just to reiterate, ambiguity looks good, realized variance looks good, and even implied volatility looks good. Everything looks good, but I don't know how useful that is, because they were also looking really good. Well, at least ambiguity wasn't, but pretty much everything else was looking really good a couple of weeks ago. So at least here ambiguity is okay. So this probably gives us a little pause, in the sense that even if there is an event on market, another liquidity event, it might take a little while to happen, at least until liquidity recovers above the 0.2 level. So what is the trade plan going forward? Well, we continue doing our VRP trades for 5 sessions. I think that has been a good system. In fact, we have a signal today for it, and which is good. And I might or might not switch to 3 sessions, all depending on how volatility remains. If volatility remains very, very subdued, I mean, if we continue being below 10% for the near future, then we should switch to 3 sessions, because that way we will not get caught if there is a volatility event. I mean, we will have 1 or 2 trade stops that might go bad, but then we will adjust really quickly, as opposed to VRP trades for 5 sessions. They take a longer time to adjust. So that's kind of the plan there. Okay, so let's take a look at the variance center in the meantime. So let's see what is going on today. So the variance center, for those of you that don't know what it is the main tool we use to visualize the market. It gives us a lot of insights into the market. You can see the gamma threshold at the top left, and it has changed a little bit, but it remains. We are in a long gamma regime. I have a question that says, "Hi Leo, will you consider adding open interest number in the gamma optimizer tool for individual strikes?" Yeah, I mean, you can always see open interest all over the place, but yes, I could add it there. I mean, we have a lot of tools to analyze order flow, but yes, I mean, it's not hard to put open interest. I could add it. Yes, a good suggestion. So you can see the imbalance, and the 1% move up and down. The balance is a little higher now since I prepared the slides, and this is a sign. Every time that this is above 20 billion, remember that the imbalance is in millions of dollars. So this is 27.6 billion of selling. It's a lot. So whenever you see these really high values, then we should expect to see very low realized variance, and that's what we are seeing. Look at the realized variance today. We are seeing only 5.17. No, this is like watching paint dry, and that's what's happening, and that's an effect of the being long gamma and tremendous imbalance. And also, it's helpful to visualize the imbalance across the strikes. So this is the total imbalance across all of the options in the S&P 500 and all of the strikes. By breaking the imbalance down, you can see the big hedging walls, what I call it, and you can tell that 3,900 is one of those. There is a lot or gamma on this thing, and we are in that region, and that's why the market is so slow. And you can see that it is growing, the 3,950 and even the 4,000. Those walls are starting to grow. So there is a lot of gamma being accumulated on those strikes. So I guess I'm seeing some players are looking at 4,000 already, which is really close. I mean, if the market really wants to go to 4,000, it's only 85 points up. It's not that hard anymore. At these levels, those moves are in percentage already small. In terms of kurtosis today, is remember, perfect kurtosis, perfect random Gaussian distribution is around 3.0, and we have it 2.39, a little below 3.0, which means most of the what is happening today has been below the Gaussian limit, like lots of small returns. So that means that there is almost no organic trading. There is very little trading. There is no, probably no institutional trading, because all the returns are being bunched up around the mean, and so there is not that much volume that is moving, and liquidity is plentiful in terms of that. Okay, so I have two more questions. Any advice for ULG40 traders? Yes, I will talk about the ULG trades in a bit. It is possible to see short float somewhere. You mean the short for the stocks, the open interest, the short interest for the stocks? Yes, I mean I don't have access to that information right now. I don't use it, but I know there are some public sources for it. I don't know how frequent they update, but I know the Wall Street Journal has it and Bloomberg has it, but I don't have it. I will have to pay for it, but I don't use it. No, I don't use short interest at all on the tools. So let's look at Ultra, which is the start of the game. So Ultra has three potential trades, and all of them are go today. All of the trades to the ULG20, ULG40 are long gamma, and they have a green signal, and that's because the prediction from today from Ultra is so optimistic. Ultra, the prediction for today is, remember, it's always the first row. You can see the mean is predicting is gigantic and very low standard deviation. Like Ultra is so optimistic into next Wednesday, which is amazing. No, I don't know why Ultra's like that. So we have all of the trades, and if you are part of the group that follows the ULG40 system, well, I will take it. We took one little unofficial ULG40 and it worked really well. That was fantastic. So I will take this one. I mean, the risk reward is really good. I will even take the ULG20. I mean, this is cheaper. It's only 95 cents. But if you're willing to spend the $2, that's a good one. My plan is to do a VRP20 trade by the end of the session. We'll see what kind of, remember that these trades are only meant to be done around the close, not around 4. Ideally after 4, SPX options trade until 4:15. So if you can hold the trade as long as possible, it will be really good. So yeah, we have a trade today. There is a go signal. It hasn't changed, and it's very unlikely that will change from here to 4. So keep an eye on it. I have a question from Richard. He says, is Ultra saying a spike up is coming on the 17, or is the reading too much into the information? Yeah, I know it's very tempting to remember that Ultra is a convolutional network that predicts a Gaussian distribution. So this is a Gaussian distribution is the combination of these two things. So for the 17, like let's look at the 1 sigma probability. Let's look at the 84% confidence interval, and so it's predicting a range between 3,896. Wow, and 4,015. So it's a range. It doesn't mean that the market is going to be centered exactly at the center of the mean. No, it's just that it has a bias. The mean is being biased right now. After a few sessions of having negative bias for the mean, like those means were really neutral. Means below 1 are very, very neutral, but this mean is not neutral. It's really far from 0. It's comparable to the standard deviation. No, the mean of 1.02 and a standard deviation of 1.52 are very comparable. So yes, there is a bias for some reason, but I will not interpret the bias as saying that the market will be exactly 1% up from where it is. It's just that there are really good odds that it will be 1%, but it could be, remember, in in the 1 sigma, it could be around 3,996. And if you want to be even more like the 95% confidence interval, then this interval grows a lot. And the market could be anyway between 3,839 and 4,075. It's a gigantic range. So the market could end anyway there. But Ultra does what Ultra does, is predicting this kind of Gaussian distributions where the market might be 5 sessions ahead. The only thing that helps us is that it gives us some edges on some trades. Now, we take these trades because there is an edge. And for instance, the edge is gigantic here. Usually this trade should have an edge of 40%. And according to Ultra, it has 63. I mean, the probability of success is 63. So we have an edge there because it has higher probability than where it's priced. The same with the 20. The 20 is very attractive because the probability of success of this trade should be 20%, but it's double according to Ultra. So it doesn't mean that the market is going to end up above 3,975. What it means is that playing it has a good odds. I mean, if it works, you are basically having a nice trade. If it doesn't, well, you lose the money. But I mean, it was a good bet. You have a positive edge on the bet. That's how you should see Ultra, not as an absolute prediction of where the market will be. So that's it in terms of the variance center. Let's come back here to the presentation. The reason I plan to switch to 3 sessions is that to avoid what happened to us when we have the event, the liquidity event. The liquidity event killed 3 trades in a row, although it was very easy to, the losses were really small, but, it killed 3 trades because when you have 5 sessions, it accumulates 3 trades right away. But if we switch to 3 sessions, the maximum it accumulates is 1 or 2 trades. So if something happens, we are only get caught with 1 or 2 trades on. So that's what I want to switch. And I have a question from David, like how significant is P0 bigger than 75%? Well, those probabilities, let's come back here. Yeah, so this probability, so of course they are affected by the mean. No? The probability of being above this level next week is substantially high. And I know some members of the room have done a statistical analysis on this. And I forgot, one of the members posted a system doing this and going back all the way to 2020, and it seems the system works. It seems taking a long trade with the probability was bigger than 60% or 70%, I forgot what it was. But yes, I mean, it's just a matter of doing data mining and seeing how significant it is. I put these things here just for your quick reference, but I don't have trades for this because I prefer to have this kind of trades where the price is constant and the probability is variable. In this case, this trades, the probability, the move is always constant, and so the cost is variable. So I prefer to have variable probability than variable cost because it's easier to model. You can model drawdowns and you can model all sorts of things, but I mean, you can always, I make this data available to everyone, so you can data mine it. But I will say, yes, there are the odds that the market will be higher next week from this level, according to Ultra, are really good. You know me, you guys know me. I'm always skeptical of my own tools, but I take trades that have good edges, and so I take trades. I like the VRP trade, and I like the ULG 20 and 40 trades. Okay, so I think this is all for the session. We keep it short, half an hour. If you have any questions, this is the time to ask them. Remember that there is a delay, so I'll wait for a few seconds. Otherwise, I'll really appreciate you guys joining. For those of you that are from the outside, I hope you at least got something out of this. I know it can be a little intimidating because of the specific lingo that we use, but I really appreciate you guys coming here, and you can always go to my room and ask questions. For those of you that are members of the EWT main room, remember you can try the service 2 weeks free. I mean, for everyone, even for those of you that are from outside EWT, you can always test the room for 2 weeks completely free and see if this is for you or not. And again, any questions, please let me know in the room or send me a message. And I really appreciate you guys joining. Take care.